Do you want to invest and grow but aren't sure what to do with it? As in, should you choose a variety of stocks? Should you take a plunge into the future and purchase cryptocurrencies, cryptography-secured digital currencies like Bitcoin or Ethereum? If you want an answer to these questions, watch the video. We will show you 5 tips or ways to start building a retirement plan. And also remember to do your own research before you invest. What is shown in this video is not financial advice. Now let's start the video with 3 major differences between stocks and crypto. Even though cryptocurrency and stocks are valid investment choices, they serve different purposes in a portfolio. Stark differences exist in how they're bought and sold, as well as how they serve an investment strategy. First major difference between them is ownership. Like to buy and keep stock. A buyer usually has to open an account at a brokerage such as Charles Schwab, TD Waterhouse, or Fidelity. The brokerage makes trades and holds stock in the buyer's name. On the other hand, one of the claimed advantages of cryptocurrency is its anonymity. Nobody needs to know who the cryptocurrency buyer is. A cryptocurrency owner's assets are stored in a virtual wallet or on a storage device, such as a USB drive. Second major difference between crypto and stocks is regulations. Stocks companies are compelled to disclose all information that could affect their stock value. Investors and their financial advisors have a wealth of information to draw upon when making investment decisions. In contrast, cryptocurrencies remain mostly unregulated, which some crypto investors see as a plus. Crypto markets have no borders and are not governed by any government. However, it provides no safety for crypto buyers if something goes wrong with their investment. Like recently, we saw some very famous crypto companies, including the second biggest crypto exchange FTX, collapsed, and as they were not regulated, everything is lost. Third major difference between crypto and stocks is volatility. Stock exchanges have existed for as long as there have been stock exchanges. A piece of good news can send a stock up, while bad news can send it down. Stock markets can plummet in a single day, as the phrases Black Friday and Black Monday show. On the other side, cryptocurrencies are well known for their tremendous volatility. For example, Ethereum can rise $200, $300 in some minutes, and then again falls lower too, which you can also see on the chart presented in the video. Now that the 3 major differences between stocks and cryptocurrencies are clear to you, let's further talk about financial markets available for users in which you can invest in both crypto and stocks. But before we delve into that, subscribe to our channel Money Internet if you want to listen to more tips and financial recommendations for Bitcoin and other cryptocurrencies. The first popular financial market for investing in both is Robinhood. Robinhood began as an innovative disruptor in the brokerage business, and its brand has since grown to be immensely popular with tech-savvy investors and inexperienced traders. Owing to its no-fee approach and sleek, user-friendly trading experience, the company's main distinction was initially fee-free trading. However, numerous competitors have now reduced their rates in response. On the platform, users may simply trade equities, ETFs, and cryptocurrency. Second one is Webull. Webull is designed exclusively for investors who want to enter the financial markets with no minimum account size and no commissions. Customers at Webull are younger than those at other brokerage firms. Webull has positioned itself to serve newer and more active traders, as well as others lured to a platform that provides a wide range of free services, such as no account minimums, commission-free trading of stock sets and their options, and several cryptocurrencies. Webull does cater to the self-directed investor, delivering a less complete offering than full-service competitors. This makes Robinhood and Webull each other's main competitors for buying stocks and cryptocurrency at the same platform, and you can make your own choice after doing your own research. Now let's move towards discussing what possibilities are there to earn money with both. Starting with stocks. Stocks are one of the keys to developing long-term wealth. However, while stocks can expand in value enormously over time, their day-to-day movement is impossible to anticipate with 100% precision. With that, The first way with which you can earn from stocks is by buying and holding, like buying the stocks when the price is low and selling them for higher prices to earn profits. But for this, you need extensive research and some insider knowledge too. Secondly, if you choose funds over individual stocks, the second choice will be generated. While you can buy a variety of individual stocks to mimic the diversification found in funds, doing so successfully can take time, a significant lot of investing expertise, and a sizable capital commitment. A single share of a single stock, for example, can cost hundreds of dollars. In contrast, funds allow you to purchase exposure to hundreds or thousands of individual investments with a single share. The third approach to profit from stocks is to reinvest your dividends. Many companies give their shareholders a dividend, which is a quarterly payment based on their profitability. While the little amounts you receive in dividends may appear insignificant, especially when you initially begin investing, they account for a significant portion of the stock market's historical growth. On the other hand, unlike stocks, there are a lot of ways to earn from crypto, so let's deep dive into a few major ways to earn money from crypto. Firstly comes investing as early as possible, as this is considered the greatest strategy to make money with cryptocurrency in the finest cryptocurrencies. Then come passive cryptocurrency mining. This is the second best technique to profit from high potential cryptocurrencies. You might profit from cryptocurrency by directly operating your own mining gear. However, purchasing the gear necessitates a significant down payment as well as technical expertise to put it up. You might also invest in a passive cryptocurrency mining protocol that generates earnings through mining operations. Then comes crypto staking. Staking entails storing your tokens for a set period to help authenticate transactions on proof-of-stake blockchain networks. When considering how to generate money with cryptocurrencies, you may be shocked to hear that it is possible to do so by playing games. Make no mistake about it. The marketplace for play-to-earn crypto games is currently worth billions of dollars. After this, there are a lot of other ways to, like interest accounts, airdrops, lending and borrowing, yield farming, and more. Moving on, let's see the risks of trading cryptocurrencies and stocks, and how can it be minimized. With all of the chatter about volatility in both stocks and cryptocurrency, it should be clear that you cannot put all of your resources into either. So before you decide to invest, make sure you have some spare cash. This money should be money that you do not require to meet your fundamental demands. Taking out a loan to invest in cryptocurrency or equities is likewise not recommended. Instead, experts recommend investing a small sum over a long period to maximize your profits. You don't have to invest a large sum of money all at once. Instead, expand your commitment as you have more resources to spare. For this, you can use DCA, which is the method all the big investors use. DCA is dollar cost averaging, which helps you lowering your AVG by price and recover the loss quicker than it was possible earlier. Another technique to reduce the danger if you are concerned about investing directly in crypto and stocks, you might instead invest in firms that hold crypto and stocks like Tesla and MicroStrategy. Now that the ways of minimizing the risks are clear, let's delve into if there are ways to invest in stocks and crypto together. And you can do this by buying stock in a company that has a financial stake in the future of Bitcoin or blockchain technology. For example, Tesla, which holds over $1 billion in Bitcoin and accepted Bitcoin payments in the past, is included in any funds that track the S&P 500. Since its 2020 inclusion, it's become one of the most valuable and therefore influential companies in the index. And Coinbase can also be considered, as it is the only publicly traded cryptocurrency exchange, which is also in the Cathie Wood's ARK FinTech Innovation ETF. Another way to invest in stocks and crypto together is buying blockchain ETFs. ETFs function similarly to mutual funds and equities. An ETF is a collection of stocks, bonds, or other assets. This means that when you purchase a share of a blockchain ETF, You are purchasing a stake in the fund's portfolio of investments. And now, if you are a newbie and want to start investing, this is a segment for you, so listen carefully as we discuss the best way to start investing with minimal risk. Before you put your money into an investment vehicle, you should have a fundamental understanding of how to invest properly. However, there is no one-size-fits-all solution. Whichever method works best for you is the greatest approach to investing your money. Consider your investing style, budget, and risk tolerance while making this decision. You may believe that you need a significant sum of money to begin investing, but you may start with $100. The amount of money you start with isn't the most significant consideration. It is ensuring that you are financially prepared to invest, and that you invest money frequently throughout time. This is a difficult question, and there is no ideal answer. The optimal form of investment is determined by your investing objectives. For example, if you have a high-risk tolerance and the time and willingness to examine specific stocks and cryptocurrencies, that could be the best route to go. Bond investments or bond funds may be more appropriate if you have a low-risk tolerance but desire larger returns than a savings account. And now finally, let's see the exchanges which are suitable and safe to invest in. How to check? So there are a lot of exchanges safer than expected, which include Bittrex, Gemini, Coinbase, Robinhood, Webull, KuCoin, Binance, Kraken, and a lot more. And talking about how to personally check they are safe, you must find first whether the exchange you are using is registered in your country or not. If yes, then that means you are on the safer side. And the exchanges we have mentioned are all registered in some of the countries and are regulated too. Most of them have also declared their audits, which proves that they have fund and are capable enough of returning user funds if something happens. Other than this, there are the three most vital markers of exchange security. Those are proof of funds, bug bounty, and pentest. A pentest is a proactive cybersecurity measure that attempts to breach existing security protections to detect internal and external vulnerabilities in a software program. The bug bounty program allows you to get reports on security holes from hackers and independent security experts before crooks to exploit them. Finally, proof of funds is critical because it confirms the general authenticity and liquidity of exchanges. Users have reasonable expectations of being able to access and withdraw monies from the exchange at any moment. Now we hope everything is clear to you, and it's time to fulfill the promise of providing free 5 tips to get started on building a retirement plan. The first step is to comprehend your time horizon. Your current age and expected retirement age lay the groundwork for a successful retirement strategy. Then you must determine your retirement spending requirements. Having realistic expectations regarding post-retirement spending patterns will assist you in determining the appropriate size of a retirement portfolio. The third step is to compute the after-tax rate of return on investment. After determining the expected time horizons and expenditure requirements, the after-tax real rate of return must be calculated to determine the feasibility of the portfolio delivering the required income. The fourth step is to compare risk tolerance to investment goals. Whether you are in charge of the investing selections or a professional money manager, a correct portfolio allocation that balances the concerns of risk aversion and returns targets is undoubtedly the most crucial stage in retirement planning. Finally, the fifth tip is to stay on top of your estate planning, as estate planning is another important element in a well-rounded retirement plan. Each aspect necessitates the skills of different professionals in that industry, such as lawyers and accountants. So that concludes the video about crypto versus stocks, in which we covered all of the major differences between stocks and crypto, major markets where both are available, and how to invest in crypto and stocks together, as well as how to check the authenticity of an exchange yourself, as well as highlighting how to minimize risks. Now, if you have found the content helpful, don't forget to give this video a thumbs up. Thanks for watching and see you in the next video. Until then, goodbye.